It's the Joe Simon podcast in three, two, one. Today we're talking about long term care. We're talking about the expenses, the inflationary factors behind long term care, and how unprepared most of us are about it. There are some rumors about it too, things that we tend to oh, base our financial stability on because it's a factor that won't affect us until we're older. And so it's tended to be ignored. We also look at it as something that's the other guy or gal that's going to be saddled with that responsibility. So we're going to try to tackle some of that today here on the podcast. Thanks for tuning in. And I know this isn't a sizzly or a sexy or a thrilling type of thing to talk about, like the ups and downs of the market or inflation or taxes or whatever, but it's an element in the portfolio of concerns that we really need to know about and we need to address and have the answers. You only have those answers for you and your house, but we're going to tackle those today. Um, so that's one of the things we're going to dig into. We're going to take a look at a case study more on a personal basis. I've always found that case studies, real, true to life stories, working in the details, are in some cases the best way to try to understand a topic, in particular, something like this that we hear about and we say it's a shame that happened, but in the back of our mind, we're hoping, we're praying, we're saying I hope that never happens to me. So we'll look at a case study today around that, a real time, a real true to life case study. And we're also going to go back to the American College and their financial studies. They do an annual quiz that's about 30 questions. If you've seen some of our most recent podcasts, uh, we address some of those questions from the quiz, three or four of those in there. If you're interested in taking the full quiz, drop me a line at Joe Simon at Da Vinci. Excuse me, it's jsimon at davinciinsurance.com. We'll give you all that information at the end of the podcast today too. You can go online live and take that quiz and find out how you scored. That's always kind of interesting. But let's get started. Let's get into today. Let's talk about some of the numbers behind what we're talking about. And I guess the quick math formula here is if you took $105,000 times 5 years, that equals $750,000. That's the cost that we're talking about when it comes to just assisted living in my home state of Wisconsin. It ranges all over the country. This is a good number to pick. It's a little bit above the average, not much. But one thing that holds true is the inflationary factor around long term care that we've been studying since sort of this 2.0 version of long term care concern and solutions from the insurance world have come into play in the last, let's say, 12 years. A lot has changed leading up to those 12 years when we looked at insurance products known as long term care insurance. Lots has changed. Lots of carriers that do other things that are still around have stepped away from the long term care insurance marketplace. They no longer offer new products. Most of them have been responsible in carrying on their policies for existing policyholders. But we're going to concentrate on really what has happened in the long-term care world and how the insurance industry has sort of married into that to become more consumer friendly and more understandable and better with consumer awareness and effectiveness and compliance. But back to the math problem, 105 times 5 is 750, $750,000. That's the elephant in the room that we need an answer to. The realities of this are if you go to just assisted living, this is not the traditional 24-hour eyes on you almost every hour type of long-term nursing care, which is you need help with just about everything that you do in your life at that point. But the assisted living is a little more loosely directed. You're still in a facility. you're still getting quality, qualified care, but in a more loose, more liberal, let's say, lifestyle in the environment being watched, eyes on you during this time because you need that type of care. 105, $105,000 is that number. The inflationary factor is the concern, though. Just pick the most conservative of the numbers, 5%. A 5% increase day in, day out, year in, year out. It's an annual 5 to 7, but 5%, let's say. This really starts to add up. And as we've talked to prospects, clients, acquaintances, etc. A few years ago, the quick answer was, well, this is an easy one. I'm just going to give it all to my kids. Then I won't own anything. And then when I need care, I'm going to have it provided to me by the government because it's going to be free. But guess where it's coming from? Guess what arm of the government it's coming from? It's coming from the Medicaid portion of this uh, health care in America. Let me ask you, do you know anyone who's been on Medicaid? Do you know anyone who's on Medicaid right now? Excuse me. Do you know anyone who has Medicaid for long-term care financial solutions? If you do, would you rate that a 5-star type of healthcare, quality of healthcare situation, outstanding, or down to a 1, which is the basic needs, wasn't the Cadillac high quality type care that we like to say we want for ourselves, for our parents, for our spouse, for our closest loved ones. All that to say, if it were for me, I wouldn't want a Medicaid option for me. Medicare doesn't offer long term care, it doesn't cover long term care. Medicaid is the default when someone has no money left and goes into government directed care. It's a different world. We like to have our flexibilities and our quality and our eyes on us when we need our high level quality care. That's a fair statement to add in here, but it all costs money. Money, by the way, gives us choices, choices in care, choices of the type of quality care, where we want to go, not where we're dictated to go because there's an open bed. We're not going to get into all of those, I'll call them sort of muddy details today, but all this to say, before you answer, and then there's the lingering question still that exists, is the story of the answer is mentioned earlier, giving it all to my kids and then Medicaid can take care of me for free. Uh, now, uh, 10, 12, 15, 20 years ago, 25 years ago, that was viable. And there was something called a 3-year look back. And they would claw back your money and make you pay for your care if you hadn't given it all away in a qualified sort of way within 3 years. Now it's 5. Now there's a 5-year clawback. So if somebody says they'll do that, and typically it's a child, adult child, looking at where mom and dad or mom or dad are going, and they're anticipating this time of life change taking place where they're going to need more eyes on them in at least an assisted living situation. Now the federal government is taking lots of time to go back 5 years to claw back. And there have been some cases that I've heard that are real time cases that have come into play here. And what they've done is they've even gone back longer than 5 years because they've known the maneuver. They didn't like it and they made them pay everything. So, long term care solutions today, quickly moving along. Um, we can sell the house, we can tap into our 401k. So now let's say your home's valued at 400,000 and let's say you have a 401k that's 500,000. So for quick math, it's $900,000 that we have access to pay for your long-term care. Remember, it's 750. You stay the full length of time, and let's say you die after 5 years. What do we do if you've got a spouse who didn't need long-term care and has been living in the residence, the primary residence, all along? Oh, you sold the primary residence, but they still need another place to live. So you bought a condo or in an apartment of some kind of smaller residence. There's still that cost of living for them on top of your 105 multiplied times 5% interest every year. And that continues to tick. And oh, by the way, the money coming out of your 401k is what? It's a T word, taxes. It's taxed before you pull it out. And oh, by the way, you sell your house, and of course, you've lived in it for several years and you sold it for a profit. Guess what? There's taxes on the profit. We hate that T word, but it's there. The things we have to deal with. So, all of this to say, what are your solutions? What are your answers? Maybe you're comfortable with some of the things we talked about today, and that's fine. That is your plan. What I would say is, wouldn't we want to have some guarantees, some life jackets around that if things happen quickly? Let's say we're in a down market when it comes to selling your home. One of you needs to go into a long-term nursing care facility, and either it's the wrong time to sell your house because of what you're going to get in value for it, or you're trying, but you just can't move the house. Let's say we live in a different income tax environment and you are in now because of what the taxation schedule has done, it's increased. So more taxes are coming out of your 401k before you can get your hands on the after tax dollars. Wouldn't it be nice to be able to pay for long-term care with tax-free dollars? There's an idea. Would you be interested in knowing how something like that works? Do you have something like that right now? Business owners, did you know that you're incentivized to actually purchase a long-term care policy on your own through your business for yourself? Unless tax schedules and deductions change as of September 2024, that still exists. It's different for each person and it's different by the type of corporation you have, but there's definitely a tool that you need to be aware of if you're a business owner and you're concerned about this issue for you and your house, for you and your spouse, for just you. So I know we're talking about a lot of stuff in this regard today, and I don't mean to come across in any other way than trying to get all the tables out on the table, all the cards out on the table to flip them over and go, I didn't know about that one, or I know about that one, and I've made a decision on what the solution is going to be for me. But what we do know is that 70% of people between the age of 60 and 65, 70% will need some form of long-term care during their lifetime from this point moving forward. This is one of those things that's just going to happen. It's like the sun going up and the sun going down. It's going to happen to 70% of us during this time frame that we're entering now in or sort of on the tail end of. And you may have your own stories that you've lived through. There's a lot of financial stress, there's a lot of emotional stress. It's been known to tear families apart because certain members of the family want certain levels of care and the things around that, and other family members don't deal with it well. A couple of the solutions that we may want to look into for somebody like you as you listen to this is looking at where your money is today and reallocating in a more beneficial way. It's beneficial, but there could be a more beneficial way. Life insurance policies today offer long-term care riders on the insured, not the owner, not the beneficiary, but within that life insurance product, the policy on that person's life. You can either add it or apply for a new policy, adding it in. Perhaps it's in there and you just don't know about it. We're finding that there are ways now, and this is an interesting situation taking place just in the last 3 to 4 years. I would say since 2021, there's been a boom taking place with the uh, annuity world, in particular fixed indexed annuities, because of the conservative way there's an opportunity to grow and have a decent return on your money. That's the 15-second version of it. But what we're seeing now, because of 65 the 10,000 people a day turning 65 since the beginning of this year, there's a need for people to begin to not only think about this, but do something about it. So some insurance carriers within their annuity portfolio and that chassis, that shell, that product called the annuity, within that, they're putting in mechanisms that now will enhance that annuitant's life by giving them access to money for long-term care purposes, tax free. So here's a real-time case. Let's say the individual is 60 and his spouse is 61, 62, in that age category. They each have an annuity that has $100,000 in the annuity. It's growing fairly nicely. It's a very conservative type of, let's say 6%. They're getting on this type of product, but this annuity company has come out with a way in which they can pick that money up, reallocate it into their product that now allows them, that annuitant, to get at the money tax free, even the growth, if it's specifically for a qualified long-term care claim. Underline that last few words: qualified long-term care claim. That's qualified through the physician, the attending physician for that patient, the medical director or directors of that insurance company, as well as verification that there is an entity where this person is staying at, the annuitant is staying at or having come into their home. There are documents that qualify this, and once that gate is open, everything is checked off and approved. There's tax-free access to this money. This is a lifesaver. So it's basically not spending more money, but better thought on the money you've already had. The last part of this today, and then we'll get on with the quiz, the quick quiz questions, is I mentioned the long-term care rider within the insurance product, within the annuity product today on a tax-free basis. By the way, coming out of the life insurance policies, also a tax-free basis if it's for long-term care, coming out of the death benefit level. That's very interesting. And then, of course, there's the uh, access to an actual long-term care insurance product. It's a policy. Typically, we're seeing these types of policies with a large pool of money that you buy into. That's the policy design. Uh, Typically, five, six, $700,000 of a pool of money divided up over the course of a few years that you purchase in advance. It's all designed in, and you buy this with your after-tax dollars, and the benefits are paid to you tax-free. They are not cheap. I hate to use the word cheap, but let's say it for what it is. They're not cheap. Are they expensive? Well, expensive is relative. If $105,000 is what you pay for self-insuring it through your own pocket, through your own checkbook, versus perhaps, depending on what your age is, let's say you're 50 right now, a policy like this could be $5 to $6 or $7,000 a year. It really depends. It depends on a lot of factors, but that's a ballpark. So why are we talking about this today? I know I said this in the opening comments. It's because it's a real issue and we don't like to talk about it. And there's a heavy emotion around it, but it becomes less emotional and less stress-free when you have the dollars on hand to make the keyword choices along the way. this is one option available to you. Quick case study. This actually happened to a client of mine 20, 22 years ago. We'll call her Bonnie. We'll call him John. Um, they were recently retired. They were in their late 50s after their advisor went over the costs of buying a long-term care insurance policy for them. John determined their financial situation was fine and they weren't going to buy it. 7 years later, John died, leaving his wife Bonnie a widow, and life went on. Bonnie was taken care of. Things were moving in a nice direction. Bonnie was taken care of financially with projected vision looking down the road. But their advisor came back and said, okay, it's been a couple of years since John passed away. It's time to reconsider long-term care. Here's the costs of long-term care as life has gone on since we initially talked, since John died, and now there's 7, 9, almost 10 years later. And a great discussion was had, and Bonnie decided to move forward, getting her own long-term care policy. Fast forward to the COVID years, 2020. Bonnie's several years older. Bonnie needs long-term care protection because of where she was at in her life health-wise. And guess what? The policy was there. The policy paid 100% of her care for the 2 years she was in a long-term nursing facility. Miraculously, her health improved where she was able to go back to her home. 18 months after that, she went back into an assisted living facility. The switch was flipped on again, and her long-term care began to pay again for assisted living care at 100%. Now, the end of that story, the final page of that story is true because it was me who was the advisor and my parents were the clients. And the whole family sat back with their fingers crossed when it was time to flip the switch and get the benefits paid from this insurance policy Mom had been paying into for several years. She has far exceeded the cost of the premium in just the first 2 years of her first stay in long-term care. She's beyond that now into the third year, going into the fourth year of needing financial payment from her long-term care insurance policy for the quality care she was able to choose for herself. So is there emotional tie to this? Is there a personal feeling of this? Absolutely. I'd do it the same way all over again. And my mom would say the same thing. She continues to enjoy high quality, long-term assisted living care. And myself and my siblings feel a lot better about that. Here's an idea. If you're a family and your parents are still in their 60s, maybe even into, I would say, late 50s into the 60s, wouldn't it be an interesting conversation for you to have with your siblings about chipping in and buying a policy for mom or dad or mom and dad? Imagine that for a minute. That's an interesting conversation to have. All right, enough of that. I'm going to go to the quiz that our friends at the American College do on your financial literacy. And we're going to read a couple quick questions, see how you do. And again, if you want to know how to get access to the full quiz and take the quiz yourself on your own time, in your own personal space, we can give you that too. But here's the first question. What is the proportion of population that is going to need assistance with activities of daily living and need long-term care at some point? Is it 10%, 50%, 70%, or I don't know? We opened up with this comment, it's 70%. 70% of us will need something down the road when we're in our 60s to 70s, 70% of us. Here's another one. I like this question. Nationally, who pays the majority of long-term care expenses provided in nursing homes? Is it Medicare? Is it Medicaid? Or is it I don't know? It is Medicaid that pays the majority of this because people aren't prepared and the government takes over and starts to set up where the next open bed is for us to go and get our care if we don't have any other sources. Here's another question. Nationally, who provides the majority of long-term care services? Is it family members? Is it nursing homes? Is it hospitals? The answer is family members. Family members. Long-term care insurance is intended to cover hospital expenses, emergency rooms care, or Alzheimer's care. The answer is Alzheimer's care. One last question today. True or false? Medicare typically pays for the costs of a nursing home for the first year. True or false? True or false? False. Medicare does not pay for the typical costs of nursing care for the first few years. So that's today's story. If you want to contact me, you can do that directly at jsimon at davinciinsurance.com. Ask me for the links to this. We have a Social Security calculator directly linked with the Social Security Department, public access for everybody. But we have that link. We can send that to you. We can send you this quiz that we just did through the American College, and you can see the full 30 that talk about a lot of different things and gives you an idea where you stand today. Things change. Maybe you did something like this a while ago, but things change, don't they? And as always, I appreciate your time. Have a prosperous day.